So you thought about investing in rental property because you've heard it's a great investment with special tax benefits. On today's episode of Personal Finance FYI, we will jump right in and give you the straight scoop. So you ready to get started? Personal Finance FYI starts now. Welcome back to Personal Finance FYI, the web program designed to help you make smart financial decisions and to grow your wealth. The real estate market is heating back up, so on today's broadcast we are highlighting direct-owned rental property. As a financial planner, I'm often asked by clients about the tax benefits of investing in rental homes. As their incomes grow, clients are looking for ways to reduce that taxable income as well as increase their tax deductions, and the topic of rental homes always comes up. With rentals, I've seen both the good experience and the bad, so I always try to give both sides when discussing with clients. Don't get me wrong, I love real estate as part of an investment strategy. It is a great diversifier and a tangible asset that you can actually touch. But unlike a stock or bond, it isn't liquid and can also require a lot of your time and money for ongoing upkeep. Not to mention that it can also come with tenant issues. So just make sure that you are comfortable with all of these before proceeding. With that in mind, let's just say you've made the decision to invest in a rental home, so you are curious about how the passive income and tax rules work. How many of you have heard that rental homes are great because they can offer you big tax write-offs? The truth is, real estate can be a very tax-efficient investment, meaning that you report very little in tax income for many years, and in some cases it may offer you a larger tax deduction. Not that you want to lose money on your investment, but real estate is unique in that if you had losses in some years, it could offset some of your other taxable income. The basic rule is that if your total household income is below $100,000 and you materially participate in the management of your rental property, you can deduct up to $25,000 in losses from your rental against your earned income. Ouch, you say. No one wants to lose that kind of money, but at least if you did, you could deduct it. With a traditional investment like a stock or a bond, your losses are limited to $3,000 annually. However, and this is the big point, as your household income rises, that rental loss deduction is phased out. So how does this all work? All income and expenses for a rental property are listed on your Schedule E of your tax return. You'll see on line 3, you list the gross rent income, and from lines 5 through 17 you list all your associated cash expenses with the property, such as mortgage interest, insurance, utilities, and repairs. On line item 18 you also get to deduct something called depreciation, which is a non-cash expense. You see, depreciation is the IRS's way of allowing you to slowly deduct or expense the cost of a tangible asset over time. With a single family rental house, you depreciate it over a 27.5-year term. Now the depreciation is just for the actual structure. You're not allowed to depreciate the cost of the land. So you subtract these expenses from your rental income and voila, ideally you have a nice profit. However, if it is negative, you may be able to deduct the loss. In reality, maybe your rent income covered all your cash expenses and you had several thousand in depreciation that you could deduct against your current income. Just to make things clear, here's a summary of the rules for deducting that loss. If your household income is less than $100,000 and you materially participated in the management of the rental property, then you could deduct up to $25,000 in rental losses if you had a really bad year. Once your income is above $150,000, you are completely phased out from taking passive losses on your rental unless you have some other form of passive income to offset it. Maybe you booked some gains in your investment portfolio, then you could offset that with losses from your rental. If you're a high income earner and you have rental losses that you cannot claim, they don't just go away. They just carry forward on your tax return until such time as you can use them against a passive gain, or you sell the property, which then allows you to use up all of your carry forward losses. A couple of items to keep in mind if you are thinking about becoming a landlord. Number one, as far as rental expenses, the IRS has gotten a bit stricter in defining what is a repair versus what is classified as a capital improvement. So what's the difference, you ask? A repair is an expense that can be fully deducted in the current year, whereas an improvement is something that must be depreciated over time. Now, number two is to deduct losses on a rental. You must materially participate in the management of that property. This is defined by the IRS as a minimum of 500 hours spent managing that property in the year, or at least 100 hours spent managing, and this is as much as any other individual worked on that property, and you did not pay a management company. Number 3 is if you are claiming the property as your rental on your Schedule E, there are rules for personal usage. You are allowed personal use of the property no more than 14 days or 10% of the actual rental days, whichever is less. Any more usage and the property could be deemed mixed use or a second home, and many of the expenses will not be deductible. Of course, I've simplified some of these explanations here, so please consult your tax advisor prior to starting your real estate empire. For a quick overview of the allowable expenses that you can deduct with your rental property, just go to theadvisoryfirm.net/rental.pdf for a printable tax organizer. Until next time, I'm James Daniel, and I will see you on the next Personal Finance FYI.